up, everybody? Today I'm going to show you how I will use stock options in order to buy Tesla stock at a cheaper price than what it's selling for today. Now, if you're new to the channel, I am a full-time options trader. I bring in multiple six figures a year just trading options, and I also own multiple businesses that all do over 6 figures a year. So if you're new to options, just stick around because you're going to learn a lot. And if you have some experience with selling options, stick around as well because I'm going to show you a better way to go about it. Now, the best way in order to buy a stock cheaper than what it's selling for today is if you sell a put at a future date. But there's a specific way that you should go about this. So before we make our trade on Tesla, let me show you a little bit about selling puts. First off, there are two main objectives to selling puts. One is to make money and the other is to buy a stock at a cheaper price. Those are the two main reasons that a trader would sell a put. Now, you may often hear selling puts referred to as short puts, naked puts, or cash secured puts. All right, so if we're selling a put, we're trying to make money or we're trying to buy a stock at a cheaper price than what it's selling for right now. So let me show you what selling a put will actually look like. So let's say for this example, we have stock ABC that is currently trading for around $100. And so we want to get this stock at a cheaper price or make money from selling puts. So we decide to sell a put at $90. So down here, we'll have a strike price of $90. We'll say the contract expires in 30 days. And for this, we received $75. All right, so we were paid $75. Now, let's say throughout the lifetime of the 30-day contract, the stock price moves, it keeps moving. And whenever the contract expires, it expires above your $90 strike price. Well, in this case, which is the most likely scenario, is you keep your $75 and you go about your day and you can continue to do the strategy over and over and continue to bring in income from it. But let's say we have the same exact scenario on this side, stock ABC, that is currently trading around $100, and we sell a put at $90. Well, during this contract, the stock price moves, and it continues to move. And at the end of the contract, the stock price drops below the $90 and stays there. Well, in this scenario, you will be forced to buy 100 shares of ABC stock at that $90 strike price that you agreed upon. Now, hopefully you sold this put on a company that you don't mind owning, which in that case, it's a win regardless. But however, for this video, we are going to concentrate on this strategy over here, which is just making income. So essentially, as put sellers, what we are doing is telling the buyer like, hey, if the stock price drops below, by the time our contract expires, I will buy the shares from you. But as a return for my services, you need to pay me up front. So as you can see, selling puts is very much like selling insurance. However, instead of a car or a house, it's for stocks. So here's a real example using Apple stock. So an Apple stock owner is concerned that the stock price is going to crash. So you as the insurance agent or the put seller offer to sell them a put. So here we have you, the put seller, we have Apple stock price currently at $175. And then over here we have the put buyer. So you as the put seller, you set a strike price of, let's say $165 for this case. So you'll go to the buyer like, hey, I'll buy your shares from you at $165 if the strike price drops below that after 30 days. But for doing so, you have to pay me $200 right now. So you can see here, this x-axis is the Apple stock price. And as long as it stays above this $165 strike price that you set, you just receive your $200 and you go about your day. Now with this trade, that $200 is the most that you can make. However, the probabilities of you making it is very, very high. Now, if Apple's stock price drops below the $200, then you will be obligated to buy the shares of the stock at that strike price, or just close the trade out for a loss. Now let's head over to Tesla's options chain so we can see which strike price we should pick and which expiration fits our needs best. So I'm currently here at Tesla's options chain, and you can see here that Tesla is actually down today. And that is a great time to sell puts because the stock is already down, so we can set a strike price even lower than what we could have yesterday. But if we come down here, the first thing we need to do is select our expiration date. Now, typically with selling options, I like to select expiration dates within 45 days. Now you ask, why is that? That's because of time value. Time value is a big factor in options. Premium pricing and the time value decay goes the quickest within 45 days of expiration. And since we're receiving money up front, we want the cost of the contract to go down to as small as possible as quickly as possible. So we want to receive a large amount of money up front and give the least amount back. So looking over here at the expiration dates, so we do have one that's right here at 44 days. But let's say I want my money a little quicker. So I'm going to do one within 30 days to make it monthly income. So I'll go over here. We have an expiration right at 30 days. So I'll click on this. Now I'm going to scroll down. The second thing that I look for is the delta. Now the delta is just the probability that the event occurs. So if we look here right at the strike price of 150, it shows a delta of 0.098. So that's saying it has a 9.8% chance that Tesla's stock price drops down to $150 by this expiration date. So in other words, if I sell a put at this strike, I have about a 90% chance of just making my money and going about my day. And that is great, and that fits my requirements. So with delta, I like to stay under 0.15. So it looks like I could go as high as a strike of 155. But I like the strike of 150, so I'm going to play it safer and go with that strike. So we can see here on these two columns that the bid and ask price is between 1.10 and 1.14. So that means if I sell a contract right now, I can expect to make somewhere between $110 and $114. So let's just assume that I get in at the $110 price. That means for every single contract that I sell, I will receive $110 as soon as I make the trade. So let's go ahead and make the trade. So I'll right click. I'll go to sell and I'll sell a single leg. Now over here is where you select how many contracts you would like. For this one, I'll just select one for this example. And then I'll set my premium to the midpoint now, which is 1.09, which means I would receive $109 if the trade goes through. And then you'll hit confirm. And as you can see here on this row, it says that my max profit will be $109. And so if you like what you see, you can go ahead and hit the send button. And that is how you place the trade. Now, receiving money up front right now sounds really good, but what are the risks of selling puts? Well, the first one is the assignment risk. Like I said, if the stock price drops significantly, the seller may be forced to buy the stock at a higher price than the market value. So in the example of Tesla that we just did, we set our strike price at $150. Well, if the stock price were to drop to, let's say, $145 by the expiration date, then you'll have to buy Tesla shares at $150, although it's only trading at $145. So you would technically already be at a loss as far as the share price goes. However, the good thing is when you sell a put, you get assigned the premium that's received up front goes towards your cost basis. So in the previous example, we were selling the strike at $150 and we received $109 per contract. So if we were to be assigned those shares, that $1.09 will go towards our cost basis. So that would bring our cost basis down from $150 minus the $109, and that would bring it to $148.91. So in that case, you could sell Tesla shares at any price above $148.91 and still make profit. So that always helps out. Now, another risk of selling puts is the opportunity cost. If the stock price rises, the seller may miss out on potential gains. Now, as I mentioned before, the premium you receive up front is the max amount that you can get. So even if we sell that $150 strike price for Tesla and the stock price just keeps going up and up and up and up, it doesn't really matter. The most we can receive is what we received up front. Now, what are the benefits of selling puts? Well, income generation. Obviously, that's what we're here for. Selling puts allows traders to earn premiums, providing potential sources of regular income. I am, for the most part, always selling puts. I have different strategies that I use to make even more money, but I still use selling puts. I usually always have puts going on throughout the year. And secondly is a potential stock acquisition. If the stock price falls below the strike price, the seller can acquire the stock at a discounted price. So this works great if you have a stock that you're actually interested in. Because let's say I wanted to buy Tesla stock today at $175, and I was very interested in it at that price. Well, if I would buy it at $175, why would I not buy it at $150? You're literally just getting a discounted price. It's literally no different than going to the mall and seeing a pair of shoes that are selling for $250, and then suddenly they're on sale for $200. Well, if you like them at this price, why would you not buy it at this price? So selling puts is a great way to buy great companies at a cheaper price. But if you're interested in learning more on how I use options in order to bring in my full-time income, feel free to join my community called Trade to Freedom. Within this community, not only will you get a full A to Z course on how to trade options, but you also have access to me and get to see my actual trades in real time. We literally have other members in there following my exact trades, making full-time income. So if you'd like more info, the link is in the description below. So can't wait to see you there. Trade to Freedom, come join us. And I'm a big fan of Tesla. I actually have a Tesla Model S, which makes me love the company even more. I could tell you what, once you go to electric, you're never going back. But I would like to buy Tesla's company at a much cheaper price. Talk to you soon. Peace.